The global and domestic economy is going through a tough time. The market volatility has gone up as well, and to make things worse, inflation has surged to an all-time high of more than 6%, along with some strict taxes imposed on private investors. What better time to refer to the 4 golden lessons by the greatest investor of all time, Warren Edwards Buffett. CEO and chairman of Berkshire Hathaway, Warren Buffett belongs to the top of the investing elite throughout the world. And for those of you unaware, Berkshire Hathaway is a conglomerate holding company which has produced the most remarkable returns ever recorded for its investors. After its listing in 1965, the stock price for Berkshire Hathaway has gone up by 20.1%. And during the same time frame, the S&P 500, which contains 500 of the biggest companies in the US, has given annualized returns of 10.5%. Buffett, along with the vice chairman of Berkshire Hathaway, Charlie Munger, has consistently outperformed the market and has made a fortune out of it. His portfolio, according to the latest statement, contains some of the best performing companies like Bank of America, Apple, Coca-Cola, Kraft Heinz, and Occidental Petroleum. But the million-dollar question isn't about his stock holdings and what the great man is up to. It rather revolves around how an average Indian investor can implement Buffett's strategy in the contemporary Indian stock market. These are the 4 major lessons from Buffett's investing strategy. After days of thoughtful research and practical applications, we have finally put together the 4 major lessons which can help you turn the tables in the Indian investing landscape. So make sure you watch the video till the end and press that like and subscribe button if you enjoy watching videos related to financial independence and stock market independence. Lesson 1. Invest in yourself to stay ahead of recession. We've been hearing it over and over and over again that the best thing you can do is take some time out and invest in yourself. As Buffett says, be a little smarter every night you get into bed. In one of his interviews with Forbes, Buffett said something that inspired millions all over the globe. The best thing you can do is to be exceptionally good at something. Whatever abilities you have can't be taken away from you. They can't actually be inflated away from you. The best investment by far is anything that develops yourself and it's not taxed at all. And Charlie Munger puts it as, the best dividends you'll get are from investing in yourself. This is exactly why Buffett believes that an average investor can stay ahead of recession, inflation, and other financial problems by developing a habit of investing. Let's just take an example. In 2022, Tata Consultancy Services combined with the Technical Institute, namely the NTTF, to train more than 50,000 individuals so they can nourish their skills and prepare for the future industry demands and standards. In this way, Tata Consultancy Services not only invested in the betterment of their employees, but their collective effort helped them to achieve better results in the long term. And at the same time, they helped their employees to develop a better skill set, creating a win-win situation for both parties. Investing in yourself is the best way to level up in the stock market. But the next lesson is what makes the money lessons from the legendary investor even more interesting. Lesson 2. Believe in long-term stock investing. Trading stocks can be fun, or to make it more particular, day trading can help you make some small profits in the short term. But the Oracle of Omaha thinks the other way round. If you aren't willing to own a stock for 10 years, don't even think about owning it for even 10 minutes. Now let's break this down for better understanding. While trading stocks remains a popular profession in India, it is not the best way to make big gains. Trading makes you dependent on short-term price hikes, while on the other hand, you can make big profits by harnessing the compound interest and its magic in the long term. And the next big question is, how should we select stocks for long-term investing? Research has always been at the heart of Buffett's investing career. And according to the Warren Buffett philosophy, one should only invest in the stocks of a company if its products are relevant in the next decade or two. And this is why the Oracle of Omaha believes that research should always be at the forefront of your investing decisions. Because going that extra mile before selecting a stock to invest in will always pay off big when it comes to the long term. Warren Buffett's current portfolio includes stocks like Apple, Bank of America, and Kraft Heinz, etc. And these are the stocks which have given Buffett some serious growth in the long term. Long-term investing is the best way to harness the absolute potential in stock and grow immensely. But the lesson that comes next explains one of the biggest illusions in the stock market, which is lesson 3, Don't be afraid of market crashes. As Buffett said in one of his famous interviews, be fearful when others are greedy and greedy when others are fearful. When we talk about the stock market, there are two emotions that control profit and loss: fear and greed. More specifically, when the market crashes, the emotions driven by fear are high, and on the other hand, when the market rises, greed takes over. When a stock loses value, the majority of the investors will look to get rid of that stock and sell it at low rates. But according to Buffett, when a stock is cheap, this is exactly something an intelligent investor wants, because low price means more shares. We have all witnessed the 2020 stock market crash. The market crashed more than 30% in a very short period of time, less than a month actually, and the outlook was extremely negative. Similarly, if we look at past crashes, the stock market sooner or later recovers, which means that stock market crashes represent opportunities to buy what you already like at a cheaper price, and thus increase your long-term returns. The market is not predictable, but one thing you can definitely plan on doing is to take a market crash as an opportunity rather than a misery. Worrying about a stock market crash is like worrying about a rainstorm. It's not worth it because a crash is as inevitable as a rainy day. Crashes have always been part of the natural economic cycle, and if you're prepared, you can easily weather the storm. But the real game begins with perhaps the most important lesson ever given by Warren Buffett. Lesson 4. Always invest with a margin of safety. For those of you unaware, margin of safety is a principle of investing in which an investor only purchases securities when their market price is significantly below their intrinsic value. In other words, when the market price of a security is significantly below your estimation of its intrinsic value, the difference is the margin of safety. Now you guys might be wondering about the important term intrinsic value. Intrinsic value is the true value of a stock, irrelevant of the current stock price. It is calculated by estimating the growth potential of a stock. For example, if a stock is currently selling at 30,000 rupees per share, but after some estimations about the product and growth potential, you've calculated that the stock is worth way more than 30,000 rupees and that its intrinsic value is somewhere around 50,000 rupees. This is the intrinsic value of a share. For margin of safety, the difference between the intrinsic value and the current value of a stock will be its margin of safety, which in this case amounts to 20,000 rupees. Mr. Buffett wants you to invest with a margin of safety. But what we want you to do is press that like and subscribe button for more interesting content regarding stock market investing and financial independence. Consider a truck driver making his journey across the country on a truck that weighs more than 10,000 pounds. During his journey, he comes across a bridge that has a holding power of 11,000 pounds. This truck driver will surely take a detour around the mountains and will avoid crossing this bridge. Although his truck weighs lighter than the bridge's overall holding capacity, he won't be willing to risk his life and the expensive cargo by taking his truck on this bridge. The same philosophy holds for margin of safety. According to Buffett, the first rule of investing is to never lose money, and the second rule is simply to follow the first rule. The margin of safety is perhaps the most important lesson by Warren Buffett. If an investor invests without keeping the margin of safety in mind, sooner or later they'll lose ground on their investing goals. Indeed, this is pure wisdom from the legendary investor, but many amateur investors in India fail to harness the power of such important principles. Make sure you check our video on how to select stocks for investing in the market so that you can make the most out of this video. Furthermore, which of these principles did you like the best? Tell us in the comment section below and we'll see you guys in the next video.